In his keynote address, Erskine Bowles emphasized the importance of fiscal responsibility that he and co-chair Alan Simpson identified in their report entitled A Moment of Truth. Key proposals including, as he said, reduced discretionary spending, comprehensive tax reform, healthcare cost containment, reduced entitlements, modifications of Social Security. And these were proposals that were made because of the looming financial crisis that he outlined. This morning's panel continues to underscore the challenges that we face in a world of uncertainties, exploring specifically asset management in a world of uncertain risks. In the past few years, we've witnessed striking changes in asset management. Volatility has hit record levels. Bailouts of large financial institutions were necessary to prevent bank runs and an economic collapse more severe than the Great Depression. Central banks have resorted to unorthodox monetary policies, fostering risks of inflation. Fiscal policies around the world are increasingly subject to dangerous partisan feuding. And our panelists today have agreed to explore how they think asset management has changed in a variety of contexts, from the equity strategies of hedge funds to value investors in private wealth management, as well as the fixed income market. So I will introduce each panelist in turn, providing them with about 10 minutes for introductory remarks, and then we'll open up the questions to the audience. So our first panelist is Kent Daniel. He's a professor of finance and economics at Columbia Business School. He teaches a PhD course in behavioral finance, and his research interests are primarily in asset pricing and behavioral finance. Between 2004 and 2010, Kent was with the Quantitative Investment Strategies Group at Goldman Sachs Asset Management. In 2005, he became a managing director and was head of equity research, and became a co-chief investment officer in 2009. He received his BS from Caltech and an MBA and PhD from UCLA. Kent Daniel.
Okay, thanks, Bob. Okay, thanks everyone for coming. This is a great event. What I want to talk about is, of course, asset management. Yeah, let me pull this around. Is that better? There we go. I can hear that now. So I want to talk specifically about risk management and a few lessons that I think we can take from the financial crisis. So let's go back specifically to the causes of the financial crisis. I know this is something that, certainly has been a lot written on this. And there are a number of different stories that have come out. And I think there's a grain of truth to all of these. Certainly, if you listen to a lot of the rhetoric, particularly in the last few days related to people Occupy Wall Street, that sort of thing, a lot of what caused the financial crisis from some of these stories is greed, lots of risk-taking that took place because they knew there'd be a government bailout if anything went wrong. On the other side, you hear lots of stories that what was responsible for a lot of this was government action. So, for example, the one conservative story that has gotten a lot of credence is that the government, through Fannie and Freddie, the creation of those, the subsidies to loans to people who shouldn't have gotten loans, insufficient monitoring in these spaces, led to people borrowing way too much, taking on too much leverage. Another story that is commonly heard is Greenspan's low interest rates that pushed people to, again, take too much risk. And one story, since I've become an academic again, a story that's gotten credence is that academics, economists pushed too hard the idea of efficient markets. And they, pushed the ideas related to securitization and caused a great deal of progress in the sense of, more securitization. And this led inevitably to the crisis. Okay, so I think there are elements maybe to each of these stories. Okay, one of the things that bothers me about every one of these is that there's one of these, according to each of the stories, there's some actor, be it the government, be it people on Wall Street, who kind of knew what was going on and therefore took this action because they could benefit and hurt others. And certainly, you know, having lived both in the finance industry and in academia, and having friends who are part of the government, I don't see that this was true at all. One of the striking things about this crisis is that nobody saw it coming. I can think of one exception, one person who forecast this. Now, what's interesting is, I think you know, when you think about, for example, the real estate bubble, there's a guy, Bob Schiller, who I'm sure many of you know his work. He certainly argued that we had a real estate bubble and that the bubble was collapsed. But I think Bob would be the first one to admit that he did not foresee the consequences. Okay? So what I'd like to talk about is how come none of us saw this? And specifically, I'm going to talk about the onset of the financial crisis, so the 5 years leading up to the financial crisis, and what was going on, and why it is that a lot of us were blinded to the factors that eventually caused the financial crisis. And why do I think this is important for an asset management panel? Because I think it's very closely related to how you should do good risk management. Okay? So let me just spend a couple minutes talking about something that probably a lot of you will be familiar with from your economics classes that you were forced to endure here or elsewhere. And this is something called the law of unintended consequences. Okay? And what this is the idea in economics that the actions of people, and especially of government, this is an especially important idea in the regulatory sphere, that these actions can result in effects that are neither intended nor anticipated. Okay? And if you go back in the economics literature, one of the early arguments that got made that kind of laid out the idea of unintended consequences was by a guy, John Locke, who was in the UK in the 1600s. And there were usury laws in place. And the idea was that interest rates had gotten too high, and the government felt they should cut interest rates by imposing a ceiling. And he, of course, is, you know, again, for those of you who've had economics classes, know, economists would view this as a bad thing. How come? Well, because, you know, what you think is, on first blush, oh, this is great because everybody's interest rates will come down. But of course, what really happens is, as the interest rate is forced down, fewer people are going to be able to get loans. So it's going to make society worse off. Okay? Now, one specific example of unintended consequences that actually somebody pointed out to me at dinner last night. We had a finance speaker in, and we always go out to dinner with the speaker. And as you might imagine, the dinners are pretty boring. So we ended up talking about unintended consequences, the life of an economist. Okay? This guy, Andrew Lowe, in fact, some of you may know him, pointed out to me something that a former colleague of mine at Chicago, a guy named Sam Peltzman, a study that he did in 1975. And Peltzman examined the issue of automobile safety, okay? And specifically what Peltzman looked at was the question of whether seatbelt laws reduced highway fatalities, okay? And there was this interesting result that he pointed to, that in fact, when these laws went in, there was a slight dip in highway fatalities, and then they rose again, and rose up to about the same level. So basically, they had no effect. Yet if you looked, clearly people wearing seatbelts had to make automobiles safer. So what was going on? Peltzman's take on this was that what was going on was that when people started wearing seatbelts, they started feeling safer. And when they started feeling safer, they started driving in a more aggressive way. And in fact, one of the interesting things that came out of his work was if you look at the number of highway fatalities, the nature of these highway fatalities shifted. The people driving the cars actually were a bit safer, but it turns out they were hitting a lot more pedestrians. So more pedestrians were dying, okay? So very, very consistent with his story. Okay, so now let me just kind of shift gears here, and let me talk about what happened in the run-up to the financial crisis. One of the striking things that you see if you look at the data between 2002 and 2007 is a huge decrease. And remember, 2007, now I'm going up to the start of the financial crisis, but not including the financial crisis, okay? If you go from 2002 to 2007, there are a number of risk measures you can look at. So certainly one that almost everybody's familiar with is the VIX, the volatility index, which tells you how we will often talk about this measure, in fact I do this, is indicating how risky the stock market is. But it's a measure of short-term fluctuations in the price of the S&P 500, okay? And if you look in mid-2002, the VIX was at about 45%. And by the time you get to February 2007, it had fallen to actually a low of 9.7%, which is just about the all-time low. And it's actually really, really low. Okay. This is kind of surprising that risk came down so much. Turns out if you look at other risk measures, you see exactly the same thing. Okay, there's an index which probably fewer of you are familiar with called the CDX. And the CDX looks at the riskiness of high-grade corporate debt. Basically, you take a bunch of CDSs on 125 investment-grade bonds, okay, and you look at the price of these, because this is a measure of how much it costs you to insure this corporate debt against default, okay? And if you look at the CDX in 2003, it was at about 95, and by the time you get up to, again, February 07, you'll see a lot of things happened in February 07. It hits its low, which is 28. Okay, so that's a more than 60% fall. One particularly interesting security that's out there is they do something called tranching the CDX. So in other words, you can buy insurance on the very first losses, i.e. what if just one or two of these bonds default and you have some minor losses? You can buy insurance against that. Or you can say, what if you want to only buy losses if this high-grade corporate debt loses more than 30% due to default? An almost unimaginable event, right? Okay, well, it turns out you can buy that insurance. And if you look in 05, the cost of that, which seems about right, was about 15 basis points per year, i.e. 0.15% per year to buy that kind of insurance, right? Turns out by the time you get to February of 07, you could buy that insurance for 0.8 basis points per year, so 0.008% of the nominal per year, i.e. people were willing to take just in, you know, what you would argue are, whether these risks are substantial or not is a hard thing to say. You could argue nothing like this has ever happened, but people were willing to sell this insurance practically for free. Okay, that's how much what people were willing to do for yield enhancement at that point. By the way, when you get to the middle of the financial crisis, the cost of that risk jumped up by just about a factor of 100. Okay? So what was going on here during the financial crisis? What was the source of this decline in risk? Well, I think there were a number of things. Clearly, there was a sense within the US and globally that things were going really well. A lot of you might remember that I think in 2004, Ben Bernanke gave his talk that was titled The Great Moderation, about how via government action, kind of learning to run things, we'd managed to make the world a lot safer place. I think a lot of people bought into that story. So certainly you look at stock prices, which is the area that I worked in over the last 7 years leading up to the crisis, lots and lots of money flowed into stat arb strategies, and these, I think, had an effect of stabilizing prices. Okay, now, how much risk did these various hedge funds take in these stat arb strategies? Well, typically what you do is you say, I kind of feel comfortable with a certain level of risk. So what I'll do is if the market risk falls, I'm willing to put more and more capital to work. Okay? And if you look at what happened in these hedge funds between 2002 and 2007, lots of capital flowed in, volatility fell, everybody concluded that the world had changed, it had become less risky, and as a result, everybody increased leverage, they increased the size of their positions, okay? So what we used as a measure of risk there was the amount of volatility in the market. People responded to this decreased risk by increasing the leverage that they were taking. Okay, now the problem is, of course, volatility is a very short-term, it is a measure of risk, but it's not a very good one. You need to think deeper about where is this decreased volatility coming from, and that's where people weren't doing this. Let me give you one more example. It turns out, when you look at this volatility, it had bigger effects than just hedge funds. So in particular, if you look at investment banks, Bear Stearns had a leverage ratio of 20-1 in 2002. Okay. Now, one of the things that we're all aware of is that they switched from from longer-term financing to shorter-term financing, okay, which is certainly a lot riskier in terms of rollover risk, this kind of thing. But in addition, their leverage over this period, by the time you get to 2007, their leverage had increased from 20-1 to 40-1. Merrill Lynch, they'd gone from 16-1 to 32-1. Morgan Stanley and Citi were both at 33-1 by the time you get to 2007. So you know, certainly with the benefit of hindsight, these leverage ratios look incredible. Because if you're at 40 to 1, that means you lose 2.5% on nominal, on capital, and you know, you're underwater, okay? So I think why were the investment banks doing this? I don't think it was because they thought there was a government bailout that was possible. I don't think anybody foresaw that this could happen. I think what was going on was people had ignored unintended consequences. So what do I mean by this? Well, think about Peltzman's story, right? What happens when automobiles get safer? People take more risks. This is a natural response. We see the same thing in financial markets. As the markets appeared to be safer, what happened was people levered up, people took more and more risk, and of course, in the end, what this means is that the asset markets are going to become inherently less stable, okay? So this is something that I think had the risk managers at the various firms been aware of, had individuals been aware of this, had governments been aware of this, had academics had probably a broader sense of what was going on in financial markets so that they'd been able to see this. I mean, academics certainly are very aware of unintended consequences, but in terms of seeing how that applied to the markets in particular, I don't think we did a very good job of this, okay? So it's something that I think is, it's a very key thing, and it's one of the key things that we have not paid enough attention to. Let me give you one more example, and then I'll end. And this is something that's very related to the source of the financial crisis, the very early sources. In mortgage-backed securities, in the academic literature, there's a wonderful paper by two guys at Stanford, Daryl Duffy and Peter DiMarzo. And they document some fascinating institutional features of securitization markets. Okay, and again, securitization has been blamed as one of the causes of the crisis, which I don't think is true, but I think there were some things that went wrong in securitization. So specifically in this Duffy and DiMarzo paper, they note that there was a lot of pooling and tranching of mortgage-backed securities. So what does this mean? Well, the way you create a mortgage-backed security is you buy a bunch of mortgages, you form a pool, and then you tranche them. So one tranche, until there are really, really big losses, you're not going to incur any losses. These are the senior tranches, right? And then it goes all the way down until you get what's called either the first loss piece or the toxic waste piece. And the idea is if there are any losses of any of these mortgages, that's the tranche that's going to get hit first. Okay, and Duffy and DiMarzo showed this actually made a lot of sense. And in fact, the way it made sense was because the issuer, the person who put together all these mortgages and assembled the mortgage-backed security, they would retain this first loss piece, this toxic waste piece. And that would keep incentives correct. Because if you're holding this piece, this first loss piece, you've got every incentive to make sure that the mortgages that you're putting into that pool are good mortgages. Because once there are any losses, you're going to get hit first. Okay? Turns out for a long time, this was the way that mortgage-backed securities were pooled and tranched. The issuer retained the toxic waste part. Okay? Well, it turns out in about the last 2 or 3 years before the onset of the financial crisis, this changed. And what happened was, initially there were a few hedge funds that noticed that these toxic waste tranches, actually the ones that were sold, earned really high returns. They started buying those. And then at some point, for whatever reason, the people who were buying the senior tranches didn't care anymore that the originator was retaining the first loss piece, the toxic waste piece. Okay, so you can see how this propagated through the system then, because once the originator was no longer retaining the toxic waste tranche, they didn't care about the quality of the mortgages, and this just fed through the system, okay, to the point where the mortgages that were going into these pools were junk. And we now all know the evidence associated with this. So again, I think what's going on here is people didn't think about the unintended consequences of these originators selling off the toxic waste tranche. So what does this all mean for risk management? I think we've developed some absolutely wonderful technological tools for risk management. But the thing that we often ignore is that there are fundamental principles of economics that need to be paid more attention to in the practice of risk management. And I think that's one of the areas we really need to pay attention to going forward.
Thank you, Kent. Our next panelist is Doug Jamieson. He's Columbia MBA, class of 1982, and he's currently president and chief operating officer of GAMCO Investors. In addition, Doug serves as president and a director of Gabelli Securities, as Director of GAMCO Asset Management, UK Limited, and as a Director of several investment partnerships that are managed by Gabelli Securities. He received a BA from Bucknell University, and he's a member of the Program for Financial Studies Executive Advisory Board. Doug, thank you very much.
Thank you, Bob. Just so I can somewhat bask in the glow of Erskine Bowles, I do want to mention that I was born in Kinston, North Carolina. It's taken me 53 years to lose that accent, but I am a native North Carolinian. I do want to thank Professor Hodrick for inviting me to participate in today's panel. It's a privilege to participate with such brilliant and accomplished individuals. As I believe I'm the only equity manager on today's panel, I'd like to approach the topic from a somewhat different perspective than my fellow panelists. Let me start by providing you with the framework of our firm, that's Gabelli Asset Management, our approach to the equity markets, and talk a little bit how we view risks and how we develop, how we address risks. The foundations of our firm, it's built on Graham and Dodd fundamental research. We have about 35 analysts who approach industries on a global basis. We are risk-averse, buy, hold, low turnover investors who do hands-on research. We build bottoms-up portfolios bottoms-up using this research. Now, in 1977, when Mario Gabelli founded the firm, it was based on a very simple principle, and that is that we will generate returns by generating returns for our clients by buying businesses that are selling at a discount. We will generate returns that for our clients, will generate returns for our shareholders and ultimately ourselves. So we've been doing this for close to 35 years, and we've generated returns for our clients close to 16% compounded. That's unleveraged and unhedged. Today we have approximately $35 billion of assets under management. We have a global brand and a franchise built on the private market value with the catalyst approach. Again, these are businesses that are selling in the marketplace at a fraction of their value, and we attempt to identify different events or characteristics that will surface these values over time. Unfortunately, there is not a uniform definition of risk. We at the firm look at it in many ways. There's operational, credit, counterparty, default, currency risk. We, like other asset management firms, face a series of potential risks in our business. However, we've structured our business to minimize the fallout from these risks. The overriding element in facing risk is the level of control within our organization. There are many checks and balances, but the key is that it is centralized. There's no new initiatives, no new expenditures, no new investments in terms of new instruments without the approval of the centralized process. There is a great deal of control within our organization. We have a centralized operation. Trading is done through a centralized trading desk. Every trade is pre-cleared for compliance with fund or client restrictions. There are 15 portfolio managers who trade through the system, and once trades are executed, they're reviewed on the following trade date. There cannot be any undisclosed trades. We cannot prevent dishonesty, but within the confines of our firm, all trades are matched T+1. Within our firm, we will not have rogue traders. The instruments that we invest in are pretty straightforward. Equities, U.S. equities, with generally limited currency risk. There is little derivatives. There are actually few derivatives. There's virtually no leverage. In our investment vehicles, where leverage or derivatives can be employed, we have continuous risk metrics reviewing the portfolios real time for compliance. Our credit risk is limited as well, as is our counterparty risk. First and foremost, we are an equity shop. Within the small pools of fixed income, the portfolios are routinely reviewed. Our operational risk is limited as well. We clear through 2 large clearing brokers, and 4 years ago, we cleared a portion of our trades through Bear Stearns. Following the hedge fund collapse in July 2007, the proverbial canary in the coal mine, we quickly moved that portion of our clearing business to another clearing firm. Our philosophy is quite simple. When you smell smoke in the theater, you quietly get up and leave. As I said, counterparty risk is alien to us. We use third-party vendors for most of our operational administrative aspects of our mutual funds and our hedge funds. What happens is that errors generally wind up being the obligation of one of those vendors. Our exposure to the new rules, the Dodd-Frank, and other legislative initiatives put in place since 2008 to prevent a reoccurrence are generally outside of our realm. 3 years ago, when the reserve fund broke the buck, even though we have $2 billion in money market funds, we were concerned, but we would not lose sleep for a simple reason. We've been there before. In the late 80s, after Drexel Burnham went bust, we elected to reduce our money market fund offerings to one fund, a 100% U.S. Treasury fund. Yes, we still have linkages into exposure that Bernanke spoke about on Wednesday, and we could end up with another round of 2008. We could see the freeze up of markets and the lack of liquidity, but as Mario Gabelli likes to say, he's been there before in 2008, 1987, 1973, 1929, 1893, and on and on. The one risk that overshadows all that we do is reputational risk. Mario Gabelli has spent the last 40 years building the Gabelli brand. That's our research process. Basically, our research team expends a lot of intellectual energy building on and ensuring the consistency of the research product delivered to our clients. So with the foregoing, what are the challenges that keep us up at night? The analytical metrics that we used when we started are not substantially different today than they were 30 years ago. The businesses that we evaluate today go through the same analytical process. What is the company worth? What are the metrics used for evaluating the business? Who are the competitors, the suppliers, the customers of a business? How has that business changed and what direction is it going? Our analysts are passionate about the sectors that they follow. We track deals very closely to constantly check and recheck our valuation metrics. We love stubs and spinoffs. This has been the same process that we've used for 35 years. Now, there's a very strong corporate culture at GAMCO. We provide all new staff with a draft of our pet peeves. It was originally assembled 20 years ago, and it draws many of the observations from Ace Greenberg's Heimchenko Malins Anenical. Our hiring of new analysts and staffers has changed a little over the years. We visit 2 schools for our MBAs, and we seek out smart people who have a passion for stocks. Now, in the fall of 2008, our clients came to us asking us to consider the use of other hedging strategies given what was going on in the markets. Of course, it would have been simple for us to implement shorting, for example, if we had a single hedge fund. However, we're managing 30 open-end funds, 10 closed-end funds, 1,700 client accounts with distinct portfolios and specific mandates. The idea was floated, but we quickly dismissed it. One thing that's changed over the last several years is the level of regulatory scrutiny. Regulators have been blamed for the failures of the system and are bent on preventing a reoccurrence. They have unlimited resources, new regulations, increased frequency of review, and increased duration of their reviews. This makes for a challenging operating environment, and it increases the risks of our operations. None of this is particularly intellectually challenging, but it detracts from what is. Keeping pace with and responding to regulators consumes more and more of our resources that could be devoted to the creativity of our research team. So with that, I'll turn it back to you.
Thank you, Doug. Our next panelist is Ann Kaplan, Columbia MBA, class of 1977. She's a partner of Circle Wealth Management and chair of the Circle Financial Group. She has taught private wealth management at Columbia Business School, and she received her BA from Smith College and an MS in social work from Columbia's School of Social Work. Anne is a member of the Business School's Board of Overseers and a trustee of Columbia University, and she's generously supported the Program for Financial Studies Asset Management Curriculum Initiative. Anne, thank you very much.
Thank you, and thank you for having me today. This is a very exciting addition to an already very robust finance program. Can you hear me? Okay, great. So I'm going to switch gears and talk actually about you and your financial life, because I'm going to focus on wealth management. Some of the inputs to wealth management are things you've already heard about: the macro environment, the availability of investment execution opportunities, such as the ones just mentioned. But the difference, I think, is that individuals experience the financial crisis in a different way. They don't experience it as how to trade an account. They experience it economically and psychologically, which makes a huge difference. So institutions, I have the good fortune of not only working in wealth management, but also being on 3 endowment investment committees, including Columbia's. So I see things both from an institutional perspective and an individual perspective, and they're very different. But the commonalities are the basic conceptual way that you approach investing. And for anyone in the room who does not have an investment policy, I'm going to make a very strong suggestion that you create your own personal investment policy, because that is the bedrock key to having a good investment experience. Because we all need, institutions and individuals need to manage risk and liquidity needs. We need to establish both a strategic asset allocation as well as tactical tilts from that asset allocation. Then we need to allocate to specific strategies, which are geographies or sectors, and then to select the vehicles that we want to use. So you can use very liquid vehicles such as single stocks or bonds. As you know, you can use ETFs all the way up to private equity, which has very long periods, so you don't have a lot of liquidity. And the way we like to think about it is that you need about 200 basis points outperformance to be locked up in a hedge fund, and about 400 basis points outperformance to be locked up in private equity. So just to say what makes individuals so unique and why wealth management is so challenging, because when I was at Goldman, I was on the other side of the business, and people who can make $1 billion of decisions in the corporate finance world become panicked if they lose $2,000 in their own account. So it's a very emotional thing for people. And also, what is truly unique is that unlike endowments and pension funds, all of you in the room have the dual reality of having to live and having to die. So you're not an institution that's going to go on forever, and you don't know when you're going to die, and you have to be able to support your lifestyle while you're alive. And this creates challenges for asset management, because when you put money into your portfolio and when you take it out has a huge effect on your returns. Also, psychological and family dynamics very much affect asset allocation. I'm sure everyone sitting here can think of psychological or social dynamic differences within their family, with their spouse, etc. And by the way, there was a study done that showed that the very best investment results were obtained by people who didn't have to consult anyone about the investments, and the worst were couples where they both were taking equal responsibility. Very important, though, and one thing I said to the students when I taught the class is the one word that I didn't want them to walk out of the class without remembering is taxes. Taxes have a major, major impact on asset allocation for individuals. Let me give you a couple of examples. There's a very, very good hedge fund that we have our investors invested with. They actually so far have a 5% return this year, which is not bad in this market. It's not great, but it's not bad. We just got a letter from them saying that although they only had a 5% return, that the taxes that we would pay this year would be greater than the 5%. Because to achieve the 5%, they liquidated things that created a tax event. So here I can talk to my CIOs at Columbia or the American Red Cross, these committees I'm on, and they'll think the same fund was fabulous this year. The individual will have actually lost money from their pocket because of the tax consequences. Number two, something that just came out this week, and I don't know whether it's true or not, but on the last tax bill, individuals were permitted to transfer $5 million per person or give a gift of $5 million per the giver, not the receiver. And it looks as though this joint committee is going to take it away on November 23rd. So this is another piece of the puzzle with wealth management that affects asset management, is that now you're probably going to see everybody scurrying, trying to transfer wealth to protect against this event. Now, the only good news on taxes is that individuals, unlike institutions, can use losses. So one of the things we do, and that you should be thinking about doing, is actively harvesting tax losses. You probably had or have losses in your portfolio. You can harvest the losses by selling that position. And if you like the strategy, just buy the same strategy from another manager, from an ETF. The result, though, is that for individuals, this kind of efficient frontier, Markowitz model doesn't work, because a pre-tax, single location, long-run time frame doesn't work for individuals, and they're not emotionally able to identify with it. So what's developed over time is a goal-based asset allocation, where you separate people's assets into a protective bucket to give them the confidence that they can sustain their lifestyle, then a growth bucket that gives them the ability to keep up with purchasing power, to keep up with inflation, and then if there's enough, you can be opportunistic and try to take a high level of risk to grow the assets. We find that using this model helps people stay the course in crises such as we're in now, which is one of the most important things in asset management. Okay, what did individual investors and families learn from the 08-09 environment? Well, they learned that the macro environment actually is important, something many people had started to neglect. That world economies are inextricably linked. People thought initially that the developed world's economy might go down, that our markets might go down, but we'd be decoupled from Asia. We learned that traditional diversification, asset diversification, which is kind of the mantra or the holy grail of the industry, frequently doesn't work. Liquidity matters. Gates can actually be put up by hedge funds. Money market funds can break the buck. Private equity can go to zero, and distribution periods can be extended. The amount of leverage underlying the various managers' portfolios was not well understood, and it was frequently not matched to the investor's actual risk-reward calculation. We also found that operational risks really do count, and that trees don't grow to the sky. So how did asset allocation, asset management change after 08? Well, it moved from being a simple allocation against fixed income, equities, maybe some real assets, and instead people began to allocate across types of vehicles, liquidity, position in the capital structure, leverage, currency exposure, and risk management. So asset allocation has become so much more sophisticated than the simple 60% in bonds, 60%, that shows my age, 60% in equities, 40% in bonds. Okay, so today, entering this current crisis, investors were already more cautious. They were beginning to balance risk tolerance with greater due diligence. People had thought they had unlimited risk until 08, and then they found out they actually didn't. People are much less enamored with complex, opaque investment structures. They ask the question when people serve up their models, how much it's based on historical data, and can we really count on the historical data. People are now using liquid instruments wherever possible and reducing the percentages in their portfolio with lockups. So people who never used mutual funds are now back using mutual funds again. And then individuals began to buy insurance, including S&P puts, treasuries, cash, and gold. And this is one thing that we did a couple of years ago. We put on big gold positions. Then in May, we got worried about the markets, so we bought puts, mainly S&P puts, but also some other puts. This is the kind of tactical overlay that wealth managements are now doing to protect people's portfolios. So individuals are now very cautious and even fearful about the ability to sustain purchasing power. Some of our clients who couldn't possibly under any circumstances not be able to support themselves throughout their life are feeling panicked. There's a huge skepticism about the market's ability to build wealth from financial instruments. The growth goal is severely challenged, and people are very much focused on just preserving wealth at the moment. Fixed income has become more desirable, and not really because people saw fixed income go up, but people want certainty of cash flow. Continued focus on liquidity and liability. Risk levels, as I said, are being tested to lower levels, and people are extremely cynical about the financial services industry, hedge funds, and private equity funds. So I just came in early this morning from a worldwide hedge fund conference in Paris, and so I wanted to just share a few thoughts that this group had that apply to individuals as well. Number one, it was very clear that most of the managers are feeling that the world is a scary place right now, and that virtually everyone is uncertain on how to position their portfolio. They're feeling as though it's what they don't know that's going to kill them. Macro is definitely dominating the micro. Market dynamics are being driven by politicians, not economic variables, which makes it very difficult to manage a portfolio. Investors, but also portfolio managers, are still shocked from 2008. They feel as though they've seen this movie before, and they don't want to have the movie end the way the movie ended in 08. So they're being extremely cautious. They've delevered. They're taking risk off much more quickly, and everyone is asking the question, what can I lose rather than what can I make? So the expectation is that the risk-on, risk-off dynamic will continue for some time. There's a generally held belief that a buy and hold strategy will not work in this environment. Having said that, it's also very important to stay the course emotionally and have balance, because you don't know what's going to happen in the market, so you can't be on all one side or another. Managers are trying to be very nimble in their trading, and individuals and managers have a lot of cash and have significantly increased their protection. So the managers in general felt that the market is just simply not behaving the way one would expect it to behave, and until it starts behaving that way, they just do not want to enter the market. So they're staying very nimble. So just to close with some things that individuals are doing in their own accounts is, again, staying liquid, having a balanced portfolio, because it's risky to be totally out of the markets, just as it would be risky to be fully in the markets, and to look at risks across the whole portfolio and be positioned for multiple scenarios, because we really don't know when rates are going to go up. We really don't know if we're going to get inflation or deflation, so you need to have protection on both. Use opportunities in the market to express long-term geographic or sector themes. Look for entry points where prices make sense. Harvest tax losses, as I said earlier. And then demand higher returns for illiquidity, and try not to be too emotional and maintain a longer-term view. Thanks.
Thank you, Anne. Our last panelist is Suresh Sundaresan. He's the Chase Manhattan Bank Professor of Financial Institutions at Columbia Business School. He teaches debt markets and markets for the poor. And his research focuses on default risk and how it affects asset pricing and sovereign debt securities. He received a BE in mechanical engineering from the University of Madras in India, and an MS and PhD in finance from the Graduate School of Industrial Administration at Carnegie Mellon University. Suresh?
Thank you, Bob. It's a pleasure to be on the panel. Can you hear me? Okay. My focus is going to be a little bit on fixed income and pension funds, issues that were touched upon by my fellow panelists, but I plan to go into them in some detail. But before I do that, I just want to pick up on something that Ken touched upon, which is, Ken went up to the credit crisis and talked about the moderation and some of the unintended consequences of that moderation in terms of risk-taking, leverage, and so forth. What I want to do is to sort of pick it up there, and then what happened following that moderation and when some of the unintended consequences actually materialized. And Bob also touched upon that. And this is that post-credit crisis, we have seen a very active interventionist policy, both from central banks as well as from governments. And they have had fairly significant impact on asset prices and spreads. And let me just give you a couple of examples. The Federal Reserve in the United States responded to the crisis by expanding the balance sheet from about 700 billion to about 2.2 trillion, threefold increase in the balance sheet, and intervened in many sectors of the fixed income securities market. Commercial paper, it was the sole buyer of commercial paper for a period of time, mortgage-backed securities, and through quantitative easing in US Treasury market. A little bit later, European Central Bank more or less entered into a very similar situation. They didn't call it quantitative easing, they call it securities market program. And they actually front-ran some of the auctions of the southern European countries and also provided unlimited liquidity for terms exceeding 6 months and sometimes 1 year. So one of the sources of risk that portfolio managers have to face is this unexpected intervention and fairly strong intervention by central banks and fiscal authorities. And what we're seeing in Europe unfolding is an attempt to engage in fiscal coordination. They set up the European Financial Stability Facility, attempting to fund it up to about €1 trillion, and simultaneously requiring that the European banks be recapitalized to the tune of about 130 billion euros. So what we're seeing are unprecedented developments in the markets, and they have had consequences for spreads and levels of interest rates. Now, in the United States, one of the things that we have seen in the pension fund industry is that the defined benefits plan, both in the private sector as well as in the public sector, post-2008 crisis, have seen significant deficits. Not very surprising. In 2008, equity prices went down quite dramatically, so the asset side of the pension plans took a beating. And following the credit crisis, authorities responded by decreasing the interest rates, which increases the present value of the liabilities. So they faced the brunt of the attack, both from the asset side as well as from the liability side. And the statistics that one sees in the pension are quite stunning. If you look at the public sector defined benefits plan, depending upon the discount rate that we might want to use, the deficit could be anywhere from $1 trillion to $2.5 trillion. This clearly has certain incentives for pension sponsors to select certain risky asset classes to make sure that they're able to come out of this hole. And I'll talk about that a little bit later. And private sector defined benefits plan, a lot of them legacy plans, are quite significant. And they're entering 2011, September 2011, with about 80% funded. That means they're about 20% underwater. So this has some asset allocation implications as well. What I want to do is to try to ask, as asset managers and portfolio managers enter into 2012, post-crisis, what are some of the things that they could have learned from the crisis? And I want to sort of look at it in a delegated portfolio setting along 3 dimensions: alignment of interests between investors and portfolio managers, transparency, and risk management, something that Ken touched upon in his presentation. Let me start with alignment of interests between investors and portfolio managers. And looking at alternative investment, the idea of a 2% management fee and 20% performance fee has been a standard feature in the hedge fund business. And the question that has been raised is, well, in good states of the world, when the fund does well, nobody has any problem in dealing with this kinds of fee structure. But then in 2008, many of the hedge fund investors discovered that funds didn't do very well. Rather than providing absolute returns, there was a significant amount of beta risk that were taken by some of this hedge fund. So one of the things post-crisis that we have seen in this business is the possibility of introducing clawbacks. In other words, there is no harm in giving 2% to 20% fees, but perhaps there should be an agreement between the investors and the portfolio managers that in bad states of the world, some of those fees have to be clawed back from the portfolio managers to the fund. And the second issue that we have seen within the context of alignment of interest goes to what Ken talked about in the context of first loss pieces being held by the originators. And the analog of that in the asset management business is, of course, to what extent the general partners of hedge funds have their skin in the game by actually keeping their capital in the form of cash and not simply waiving management fees, so that they have some skin in the game so that they wouldn't take excessive risk. So I see these 2 issues picking up greater scrutiny by way of alignment of interest. The second topic that I want to focus on is transparency. I think Anne touched upon this a little bit by talking about gates. I think many institutional investors were surprised that they were gated in 2008 and they couldn't take back their money. And so one of the issues that has come up as a consequence of the 2008 crisis is now investors are taking a much closer look at the kind of the liquidity terms that they are signing into in their investment management agreement. What are the notice periods? What are the redemption fees associated with redeeming early, and so forth. And regardless of the style of the investing, as a result of the leverage that has been taken by some of the hedge funds prior to the crisis, and subsequently the aggressive way in which the prime brokers ended up shutting down some of these hedge funds, I think investors are starting to look at what are the prime broking agreements that hedge fund managers have signed on. In other words, they want to know, since prime brokers have a claim on the assets managed by the portfolio managers, how much is going to be left behind for them after the prime brokers have had their increases in margins and, in some instances, essentially removing access to their balance sheet for portfolio managers. And finally, I just want to touch a little bit on the risk management issue. I think this is the paramount consideration. I think Anne talked about the focus on principal protection, the focus on dealing with some of the macroeconomic shocks that the hedge fund managers have faced. And I think what we are seeing here is, regardless of the style of the fund that you're managing, there is a focus on tail risk hedging. In other words, are you prepared to deal with extreme outcomes? Are you able to survive? What are the kind of the portfolio strategies, irrespective of your style, that you need to undertake to make sure that you will survive a crisis? And hedge fund managers that have been successful in dealing with this tail risk have attracted, bigger mandates, post-crisis period. So I see greater transparency, greater emphasis on tail risk management, and greater alignment of interests between investors and portfolio managers as some of the lessons that have come about as a result of the crisis. Thank you.
Thank you. I'd like the panelists now to comment. Many of them have commented on changes in the industry over the recent years, and if they would opine as to which they think are transitory and which they think are more permanent, that would be an interesting first question.
Sure. I mean, one thing that I think has definitely been the case in the firms that I've worked with more recently is people do seem to be taking a more global view, a more, I mentioned that, you know, we need to bring economics back into risk management, and I think these firms are doing that. Certainly my hope is that this will be a permanent change. It's very necessary. And what do I mean by this? Well, specifically for the asset management firms that I work with, they're being much more conscious about, are we doing the same trades as others? If things get worse, what will happen to these positions? How much liquidity have I got? So thinking on a more global perspective than perhaps was the case in the past. And I certainly hope that will be permanent, and we will see.
Doug or Ann, would you like to?
Well, I think I agree on the risk part, and wealth managers now have engaged a number of firms that provide tools to be able to analyze risk across the portfolio in ways they didn't before, and then they will put on overlays depending upon what the embedded risks are, which I think is a change that's here to stay. I think a change that's not here to stay is risk off over the long term, because if you look at the whole history of the markets and investing, people have short memories. So once things kind of equilibrate and go back to normal, I'm assuming risk on will come back with a vengeance, and then we'll have another crisis. The one change, I think alignment of interests is one that's absolutely also here to stay, and also avoidance of funds that are opaque, where you don't have transparency, where the investor doesn't understand what the manager's doing. One change that I'm going to be very curious to see whether it's long-lived is the demographics of our society are such that there's this whole huge group of baby boomers. The first group has just entered. And it'll be interesting to see whether that demographic creates a permanent shift into fixed income. I mean, we're now seeing a large shift into fixed income, but how much of it is market related and how much of it is demographics of having this very large population that's going to be retiring, I think will be interesting.
Suresh? Yeah.
I agree with Anne that you know, the risk reduction that has occurred is probably going to be temporary, and we'll see maybe in 5-6 years' time greater risk assumption by managers. But I do think that some more permanent changes have been brought about as a result of the crisis. I think investors are going to demand greater transparency about the portfolio strategies, leverage, about the liquidity terms, and also they're going to want to understand risk management in a much broader sense, not simply looking at, you know, long short or, you know, fixed income relative value arbitrage, just the portfolio style, but they're going to ask how these fund managers are getting leverage, what are some of the risks associated with you know, the leverage that they're taking in terms of the funding options that prime brokers have at their disposal. And the conflict of interest questions, greater skin in the game, and clawback provisions could become permanent as well.
Okay, let's open it up to questions from the audience. Why don't you identify yourself and then ask the question.
Sure. Well, thank you to all the panelists and all the organizers for making such a great event possible. My name is Ed Kotler. I'm a 2007 graduate of Columbia Business School and also a student of Professor Sundaresan. I can tell you that I spent the summer of 2006, specifically May of 2006, interning at a firm formerly known as Merrill Lynch on the subprime desk. And my question really goes to something that Professor Daniel mentioned in the very beginning, which is, yes, and I agree wholeheartedly that no one really saw this coming, and of those that did, I wonder whether it was just somebody always calling for a crash and being right. So I'm sure some really did, but very few honestly did, and I don't know who those are. However, I can tell you that in May of 2006, on the subprime trading desk at Merrill Lynch, being an intern, I knew that everyone on the desk did not really understand why there was still demand for this risk. This was 2006 in the springtime. And we needed to make markets for our clients. Clients were coming in and it was really one-sided. Everyone wanted to essentially do what we call do BWICs, which meant go long risk and get more and more risk, and primarily coming from the CDO managers. So later on, we saw the collapse, but there was some of that gap between 2006, and I would argue probably if I had had an internship in January, I would have seen it back then as well, to when the collapse ultimately happened. So my question is, what can we do when we do smell that smoke that Mr. Jamieson touched upon? Because everyone was smelling the smoke. Some people got up and left, but the majority did not. So what can we do to minimize that time frame from when we're smelling the smoke to when we call the fire department, as opposed to really saying, well, now the building's on fire and it's too late to get out?
Shall I? Yeah. Okay. Yeah, that's a great question. I think you're absolutely right. I think that there are very few people. So, why did? Certainly, I spoke to a number of people in a number of firms. Maybe not as early as May of '06, but in late '07, where I heard views like, I can't believe people are still buying this stuff. And there was an appetite for the securities. Probably a lot of you have read The Big Short, Michael Lewis's book, and which is very interesting in terms of maybe not developing he has some different views on why people were continuing to buy this stuff, even when it looked bad. I alluded to, when I was giving my remarks earlier, I saw one person who I would say seemed to figure this all out, and that was actually an economist who's a friend of mine, a guy, Raghu Rajan. And he gave a talk at the Fed conference at Jackson Hole. And I think he fairly accurately described that leverage in the system had gotten very, very high, and that all you needed was something to set that off, and there could be a collapse. And it was a fairly accurate prediction of what we saw. Raghu recently, he keeps a blog going, and he recently asked the question that I tried to address as well, which is, why did nobody see this? And his take on this was that people didn't have a sufficiently global perspective. So from the point of view of academic economists, he argued, there have certainly been a number of people who have argued recently that academic economists were too captured by industry, things like this, which he thinks is wrong. I don't think that's a good interpretation. Even the academic economists who had nothing to do with industry, none of them saw it coming. Rather, Raghu argues for more engagement among academics, that for the people who kind of think very deeply about the way markets move and markets work, they need to be engaged and they need to see the details. And similarly, I think Raghu would argue that for those in industry, they need to think more deeply about, okay, what could possibly happen here? So for example, why was there nobody in the bigger investment banks, or why were there very few people, I should say, in the firms who were really thinking through the consequences of, somebody's buying this stuff, why are they buying it? What are they thinking? What are the institutional features, and how could some shock, which we saw coming, be transmitted via the current institutional features? So I guess the thing that I would argue would help to prevent problems like this would be maybe better education, maybe better, in terms of regulation. One of the things that I think would have been tremendously helpful for regulators would have been to have a better take on what positions did various firms hold. How correlated were these positions? And there have certainly been some initiatives to try and make this sort of reporting better, so that the regulators who could conceivably foresee these situations would have the data to allow them to do this.
Anne? Go ahead.
I just want to take a slightly contrary view, which is that being in the markets during this time, there were dozens of people who came in to tell us that this was going to happen, and dozens of firms who came in to sell us structured products that were in effect shorts on the market. What I think happened is, for whatever reason, people wanted to stay on the merry-go-round until it finally ended, and that there were downsides if somebody stopped selling the product at a time that people wanted the product.
Charlie Rose.
I'm going to change my name. I have two questions. The first question is basically, obviously, there's a central bank initiatives to try to reflate, both here and in Europe, to try to monetize the debt. And then you have the countervailing forces of the emerging world trying to tighten and slow down their systems. And you have basically these two forces in place. And the first question I have is basically, should one be investing with a more inflationary bias or more of a deflationary bias? And I have a second question.
I've been thinking that inflation for the long run is basically what we're going to see. That these massive government budget deficits and quantitative easing that has been put in the developed world is going to end very badly. The dual mandate that the Fed has of having low inflation but also trying to foster employment has politicized the Fed completely, and they say that they have the tools for withdrawing from the quantitative easing that they've been doing, and that if we start to see a little bit of inflation, they'll be right on top of it. But the most recent meeting, you had Charlie Evans, saying we need more stimulus. We're not being diligent enough in terms of affecting unemployment, and I think that if we started to see inflation rise and the Fed tried to raise interest rates in that environment when we still had 9% unemployment, the Democratic leaders of the Congress would say, well, you can't do that, and so I think that we're definitely is going to see an inflation down the road as one way of getting out of the crisis that Erskine Bowles discussed. So that's one scenario. The other scenario is we muddle along like Japan and end up with low inflation, low or declining prices eventually, and exchange rates can moderate the differences between the developing world, which is trying to contract, and the developed world, which is trying to inflate. So, anybody else want to opine?
I actually want to comment on the earlier question. If you were to look at the CDS spread, I actually computed the CDS spread and presented to my class in early 2007. And if you had looked at the CDS spreads of some of the financial services firms, which I won't name, the implied credit rating were junk. Okay, so market did convey some information about the financial services firms, which are always first to get into trouble in a credit crisis. The other thing was, if you had looked at ABS index, the index spreads were also telling a very consistent story. So there were signals in the market, but we didn't pay attention.
Just to corroborate that point that you just made, there were many signals of New Century Financial, exactly, Countrywide Credit, many firms that went under a year or two before the investment banks got into trouble. Yep. And there were many brokerage firms that were not the larger firms, the smaller firms, Jeffries. Some of them actually were very conservative about the way they managed their balance sheet, in total contrast to Goldman Sachs, Bear Stearns, those firms.
Or MF Global.
Which is another
33 to 1
right.
leverage.
But that's,
3 years later. Like, what are they thinking?
Right. But the other issue I would just bring up is that when you look at what drives stock prices in the long run, they're driven by some correlation to returns on equity. And I'm very simplistic, so I'm not that as smart as other people, but most people look at the components of return on equity being margins or turnover or financial leverage. And financial leverage in the period of 2000 to 2008 really expanded dramatically, with corporations, including financial institutions, buying back their own stocks at significant premiums to their book equity and significantly leveraging their return on equity values without really managing their balance sheets at all. So that there were many issues there. The question I have is basically, does the bankruptcy process that you see, or I call it the restarting process, to me, it seems like a cleansing process. We had a cleansing process of many financial institutions that did get bailed out. Is that cleansing process a positive process or a negative process from your opinions? I happen to believe in bankruptcy.
Sure. So I think a very useful case study here is, Lehman bankruptcy. And when Lehman went down, the credit default swaps that were traded on Lehman, there were a multiple of the outstanding deliverable obligations to Lehman. And for a while, there was considerable debate in the market whether CDS would be able to handle this kind of massive settlement, credit event settlement. But it turned out that the auction went off pretty well, and ISDA was able to come up with an estimate of the recovery for CDS holders. I think it was something of the order of 9 or 8 cents. I don't remember on a dollar. But I think that's a little bit different from the question that you are asking, which is the actual bankruptcy process itself. I don't think that after what we have seen with Lehman bankruptcy, that the regulators have the courage to let a big financial service firm go down. So we'll probably not see that happen, either here or in Europe. That's my view.
So, what's the next question?
Great. Good morning. Thank you for sharing your insights. I'm John Capone. Doug mentioned a little briefly about in 2008, they thought about having a short strategy. So for a traditional asset manager, where do you think the growth is going to come from in the next few years with all this regulatory change, all the product innovation? How does an asset manager compete and grow?
I guess where we've focused our energies are in two venues. One is that we are looking at alternative strategies.
Yep.
The challenge there is when you're doing homegrown is one is the funding, and the second is capturing and retaining that talent. The other area that we as asset managers are looking at is expanding non-U.S. So here we've been a firm in business for 35 or so years, and we're still relatively small, but we're starting to do things very much non-U.S. Opening offices, getting through the regulatory process of those non-U.S. Offices and offering product that's going to be suitable and saleable to the non-U.S. investor.
Thank you.
Hi, I'm Evan Pico. I'm at Citigroup, and I also am an adjunct professor in the business school. I have a question. Given the context of the Great Moderation, some firms did relatively well and some did disastrously. And in looking at the firms that did very badly, a common characteristic seems that senior management imposed a kind of groupthink, very much discouraging, questioning fundamental business strategies, even pushing people out who did that, and also had a focus on short-term returns and using Ann's phrase, as long as the merry-go-round is spinning, let's stay on it, or as a former CEO said, continuing to dance while the music is playing. So none of you have addressed that issue of corporate culture, of taking a long-term view, of encouraging fundamental question-asking by risk managers or business heads to challenge corporate strategy. Part of the question is, to what degree do you think investors can understand that corporate culture and understand the actual risk returns that very large, complex institutions are taking so that they can make the appropriate investments given that decision on risk and return?
I mean, it's a great question. Clearly, corporate culture, by the way, I completely agree with you. You know, there's definitely a tendency to groupthink, and there are mechanisms that you can institute to combat that. It's a very hard thing to do. You know, in terms of how individual investors can evaluate this, I think that's extremely hard. And I think that's probably that's the role for a good asset manager, right? I mean, these are exactly the sorts of things that you want to be looking at. And certainly within the firm, I think it's absolutely crucial to encourage these sort of contrarian thinkers who are going to argue, you know, that, look, we're really making a mistake here, and you've got to pay attention to them and make sure that they have a voice within the firm.
I think it's such an important point, and it's very hard when you're doing due diligence to get it right, but one of the things when you do due diligence is to really try to drill down on the culture, one aspect of which is the compensation. Are people compensated on their own book, or are they compensated on how the firm does? Are people compensated for cultural contributions or just for monetary contributions? How long do people stay? Do the founders open up partnership positions for junior people? What's their risk process? Do they have an independent group that questions things that the portfolio managers do? So it's very difficult, and there are always surprises. But you can actually, when you do due diligence, drill down on this.
Okay, we have time for one more question.
Hi, my name is Stephen Scott. I had the interesting perspective in 2006 and 2008 of being in Shanghai, where I served as China country head for the restructuring firm Alvarez & Marsal, the firm that is now running Lehman Brothers. I offer that by way of introduction, but my question, I guess I address this to you, Professor Daniels, is, and it's a little esoteric, but picking up on your putting economics back into risk management, how would you put behavioral economics into risk management? And I think that dovetails somewhat with the last question.
Yeah. Actually, it does dovetail very well. I mean, I think precisely the things that you need to implement within the asset management, if you're on an asset management board, are designed to combat behavioral biases. I'm a big fan of the area, as you know, I think Bob noted when he introduced me. I think in terms of the economic analysis that you try to do to understand what's going on in the broader markets, I think, you know, I certainly feel that there are behavioral aspects that drive this, you know, in terms of understanding why we saw such apparently low measures of risk in the markets and such an appetite to take on risk. Why were people paying attention to such short-term measures of risk, and why weren't they taking the broader perspective? I think there's some good behavioral stories. I mean, you know, unfortunately, we haven't developed very rigorous models that allow us to utilize this, but I think you need to step back and think about, you know, why are people thinking the way they do, and often to understand that you need to appeal to some behavioral stories. And I don't think that's necessarily a bad thing.
Right.
I'm very much in favor of doing that.
Thank you.
Bob's taking the microphone.
Didn't mean to
away
cut you
from
off.
me.
Okay, so please join me in thanking today's panelists for providing this stimulating discussion.